Hey everybody, this is Charlie Dobbins and welcome to the next group coaching call for the Masterclass Elite and the Owner Forum members. I want to welcome you and talk about what we're going to be talking about today, which is how to close your multifamily deal using creative deal structures. Now, this is not about working with the seller and coming up with deal structures like seller financing or master lease option or things like that. This has to do with creative deal structures for the equity investors. How can you structure your deal so that your equity investors are willing and wanting to get into your transaction? You've got to remember that these are customers of yours as well, and you've got to provide them with a product that they want, and sometimes you may need to change that. These are a couple of different ways that you can do it. Some of you may be very familiar with it, and others of you may never have heard this before, but we're going to touch upon a couple of them here today. So first thing I want to let you know is, as usual, as required by the Massachusetts Bar Council's office, I'm a lawyer. I'm not your lawyer. Get a lawyer. Best advice I can give you right there, okay? I'm not just trying to look out for my fellow brothers of the law, my fellow brethren. I'm telling you, it's just a wise thing to do to have somebody look over your shoulder. I know I'm an attorney. I'm not your attorney, but I act like an attorney, but I don't want you to be fooled into thinking that I have checked that box for you. I haven't. You still need to have local counsel. Okay. Now, the first thing most investors do when they look at a particular deal, and I'm talking about you as the sponsor, the first thing that you do is you check out the returns on the cash flow analyzer. All right. Now, what that means is you'll look at this particular screenshot. This is a screenshot from the cash flow analysis, the CFA page of the software that we use, Doug Rutherford software. You've all seen this before. This is the first thing that I go to. They're the financial measurements. And as you can see, this particular deal has a 1.53 debt coverage ratio. That's a great ratio. I'm interested now. Tell me more about this deal. And then we look at the internal rate of return, the cash on cash return before taxes, and we're looking at a 9% return. Okay, that's okay. It's not great, but as you can see, it starts to creep up over a couple of years, but it's not enough to get some investors excited. I mean, if it's a C-class property or a B minus, you know that's a risky venture. So your your equity investors are going to want more. So we're going to have to do something about that. Now also look at the internal rate of return. So those are pretty good numbers. And the reason why they're such good numbers is I cut off the portion of the page, but this property, because of the price that we're buying it at, it's in the black right from day one, meaning we could sell this property on day 366 and we would make money. So that's why you're seeing such a great internal rate of return to start with, and it takes off from there. But that cash on cash return, that we look for in this particular deal isn't great. So what do? I mean, it's a nice property. How do we structure this? Then what we do is we go to the partnership module in the cash flow analyzer, and I'm going to talk about Dan Johnson. As if you've never used this particular module in the cash flow analyzer, you would know that Dan Johnson is the default name. And so we would change the default name into the name of our equity investor. But in this particular case, what we've decided to do is to make a split with Dan of 65-35. Now that means that when Dan shows up, and if you look down at the bottom, total cash required for this deal is $708,000, and the limited partner cash investment, Dan Johnson's investment, is $708,125. So in other words, he's putting in 100% of what is needed to close this deal. And what is he buying for that? What is he getting for that particular number? He is getting a 65% ownership in the limited liability company. Here, it says partner. But I just didn't change it for this analysis. I like to talk in the terms of a limited liability company, and you'll see that more as we go through this presentation, because I do talk about distributions, which are predominantly from a limited liability company. So in this particular case, Dan Johnson is showing up at the table with a check for $708,000, and I am going to give him a subscription agreement that says he now owns 65% of the deal. Is that going to be good enough for Dan? Well, let's take a look. On this same module, we can scroll down and we can see what the 65-35% split does for Dan. Now remember, it was like a 9% return on the first year, but if we're giving up 65% of that and keeping 35% for ourselves, now we're looking at that Dan Johnson getting a 5.95% return on the deal. Okay? Now, here is where the discussion of today's group coaching call begins. Everything I've just told you, we all know about. But now we're in a predicament. This deal is not good enough for Dan Johnson. And the solution is, well, then we got to give Dan more ownership of the company. We know that this property is only going to generate in the first year on a cash-on-cash return, we know that it's going to generate 9.15%. So if we gave Dan 100% of the returns, then, or we gave him 100% ownership, he's going to get 9.15% return on his money. But we don't want to give him 100%. If we give him 100%, we don't own anything. We've just put this whole deal together for nothing. So how can we get Dan that 9% that he's looking for, but we still retain a respectable ownership level in the deal? Now, also keep in mind that if we gave away 100%, we might be in violation of some of the loan documents. So the bank wants us to own a certain amount, and that's how we have to figure it. So in this particular case, Dan Johnson, we're going to only give him 65%. So how do we give him the 9% that he's looking for? What are the different ways that we can do that? Now, obviously, if you've done this before, what do we do when that return of that 5.98 is not good enough for Dan Johnson? Well, there are really two solutions. Okay, the first one, as I just mentioned, is we give him more ownership, or we make him creative promises. Okay, now that's how I want you to think about this, because what we're doing is we're sitting down with Dan at the negotiating table and we're saying, Dan, I know what you're looking for, and I know right now this particular property, as it's structured, can't give you what you're looking for. But I'm going to tell you right now, Dan, and we're going to put it into our agreement that I'm going to give you what you're looking for before something else happens. And we'll get into that in just a moment. So that's what I mean. We're going to promise Dan that we're going to give him what he wants. How do we do that? What are the different ways that we can structure that? Okay, can you sweeten the deal by distributing the distributions, the LLC distributions, in a manner that's going to be beneficial to Dan, the equity investor? In other words, can you make a mediocre deal jump off the page by changing the investment terms for the equity investor? It boils down to being able to split the cash flow of the deal, that 9.8% cash on cash return. It boils down to being able to split the cash flow of the deal in several different directions. What might end up happening is that the method of distribution of those LLC distributions to Dan, the equity investor, is one that's going to follow an uneven distribution model. What I mean by that is, at the beginning, we're selling Dan 65% and 35%. That's the pro rata share between the two of us. If there are distributions, an even distribution method would be Dan gets 65% of the cash on cash return and we get 35%. But what we're talking about here is shaking up that even distribution and coming up with ways to provide Dan with uneven distributions in order to give Dan what he's looking for. So these in the industry are commonly referred to as waterfall distributions. Okay, now I want you folks to listen to this. When you start talking to the big money people, when you start talking to some of the attorneys as they're drafting your PPM, you'll hear terminology, and don't get all afraid of it. The big term that this describes is what's called waterfall distributions. And you'll see that terminology a lot. And so when you see that particular terminology, understand that it's talking about uneven distributions. The uneven distributions model may also end up benefiting you, the sponsor. And we call that the promote. So don't think it's always going to be a one-way street with this uneven distribution. It could be benefiting you as well. Now, a promote is a way of rewarding you by giving you a little bit of a kicker. All right, it gives you a boost if certain investment objectives are reached. Okay, so let me give you some examples of different ways that we can come up with creative solutions to solve this problem that we're having with Dan. Okay, now a lot of you have thought, oh geez, Charlie, I know exactly how to solve this problem, because I know one way that we can come up with creative solutions like you're describing. And of course, you've all heard these things before. And what it is the preferred return, or the pref. Okay, this is something that you've probably seen before. You probably proposed it to potential investors. You probably heard about other people, like students of mine, who do these types of creative deal structures themselves in their own deal. Okay, and so it's called a pref. Now, the pref, or the preferred, it's a first claim on profits until a target return has been reached. Okay, so here's how I'm going to describe it to you. Dan, let's take it in light of Dan Johnson. At the 65% level, Dan's getting less than 6% return. Now, Dan may not like that return that's less than 6%. He'd feel better if he got a 9% return. So what do? Well, what you do is you structure the deal so that Dan gets a preferred return. Dan gets 9% of the money that comes off the distributions, 9% cash on cash return, before you, the sponsor, see a dime of it, right? That's how a preferred return works. Now remember, in this particular case, all you got is 9%. So if you give Dan a 9% preferred return and you hit your numbers, you're not going to make anything more. You're still going to own the 35%. So when the property sells, you get 35% of the appreciation, of the mortgage pay down, of all of that other bucket of money. But as far as the cash on cash return is concerned, you're not going to see a dime if this property runs as it's projected to run. Now, if it pays more than the 9%, well, that's something we're going to talk about right now. So if you were to structure the preferred return, this is what the other issues you have to deal with. You have to ask the question, is it cumulative or non-cumulative? What does that mean? That means that if you don't hit 9%, but you hit 7%, what happens to that missing 2%? Does that missing 2% get carried over to the next year? And if you make 11%, you have to pay the 9% for the second year plus the 2% you didn't pay from the year before? That's what cumulative means. Now, folks, let me tell you something. I've been in situations before with preferred returns. Cumulative is tough and can get very expensive. Think twice about whether you want to do a cumulative return, okay? Now, the other thing is, do you want to compound the interest or is it non-compounded? So if you didn't pay him all in 1 year and it rolls over, does that get compounded per year that you still owe it? Every year that you owe it, that interest rate gets compounded as opposed to the alternative, which is simple interest. Okay, now if you do a cumulative compounded return, holy cow, you better hit your numbers because that's going to get very, very expensive. So if you were to do this and try to do it the easiest way to make Dan happy with a 9% return, you give him a non-cumulative, non-compounded return and hope for the best. And if it doesn't happen, well, we'll try better next time, Dan. And everything gets rolled over to the next year. Okay, so those are some of the questions you need to ask with a preferred return. You also have to ask these questions as well. Who gets the preferred return? Does everyone get the preferred return? Do all equity investors or only the equity investors get the preferred return, or just a select group of the equity investors? Let's say that Dan Johnson here. Remember, Dan Johnson, in our example, paid $708,000 to own 65%. Well, let's say that you raised $354,000 with other investors, and you've got all those other investors taken care of. They're signed up. They're going to get the 65% of pro rata share that they've pitched in, but you're having trouble raising that last $356,000. And along walks Dan Johnson. And Dan Johnson says, I'll put up $356,000, but I want a preferred return. Remember, the first $356,000 of equity investors, you didn't have to offer a preferred return because they came in. They were friends and family. They wanted to join you, but you come up short. Now Dan Johnson comes along and says, I'll give you the 356, but I want a preferred return of 9%. Whoa, Dan, come on, I can't do that. That's going to screw up all the numbers. Well, Dan says that's the only way I'm going to do it. Well, in this particular example, I didn't really think it through, but you couldn't do that because those other people, the other 356,000, they're expecting their return too. Now you're coming along and changing the deal by giving Dan the 9%. That could end up really hurting their distribution and really changing the look of what they bought. So you couldn't really change this thing after the fact, ex post facto we say. You'd have to do it ahead of time. Unless you got all of the cash investors to sign off on a revised and amended operating agreement prior to closing, then you could do things like this for Dan. So that's the question. You might set it up so that you have Class A, Class B, and Class C. And the class, we did this in one particular deal where the kicker was the people who were who signed on the dotted line, who were actually key principals in the deal and signed personally for the deal to happen. They got a higher percentage ownership for their dollar than the people that didn't sign personally for the deal. Okay, so that's something that you can structure as well. All has to be disclosed ahead of time. You can't just pop this on people after the fact. Okay, let's see. Now, what happens to the money once the pref has been paid? In other words, you lived up to your side of the bargain. You paid the 9% preferred return. And now there's still 5% left because the property had a 14% return that year. What happens to that extra 5%? How do we divvy that up? Well, there are a couple of ways that you can do that as well. And this is where we get into, once again, some of the creative solutions to solve the problem. So, another solution, actually, let me just jump back here so I can wrap this particular topic up. What you might end up doing, remember, you can say that all the money after the 9% gets split based upon your pro rata ownership. So that would mean out of that remaining 5%, Dan gets 65% and you get 35%. Or you could initiate a promote for that additional 5% that says, hey, once Dan gets his 9%, I get more. So I get to keep 80% of everything over 9%, and Dan gets 20. Well, wait a minute, you own 35 and he owns 65. Yeah, I don't care. I'm just talking about the distributions of the deal. I want 80%. If I paid him 9%, he's happy. I'll take 80% of everything over. That's beneficial to me. That's my promote. So that means that if I bust my butt and make more money for the property, I get rewarded. Dan gets his money and I get more money. So that is another way that you can structure that subsequent, all those funds over the 9%. Now, another solution that you want to think about is what we call the look back provision. Now, here's how the look back provision works. And I tell you, I'm no fan of this for a couple different reasons I think you'll see in just a moment. Let's say you tell Dan Johnson that he'll receive a certain return every single year by the time you sell a property. So let's say that we own the property for 5 years, and I'm going to guarantee to Dan 9% return. So he's going to get a 45% cumulative return on his money at the end of 5 years when I sell the property. Okay? So what happens with a look-back provision? Every year, all the distributions are distributed according to the pro rata ownership. So remember, I'm telling Dan I'm going to pay him a cumulative 9% per year for the years of ownership, but during the course of the ownership, all distributions will be paid out on a pro rata ownership basis. So I get my 35% and Dan gets his 65%. So that means throughout the course of the 5 years, I get paid. I get paid on my share of all distributions. Now, here's where the rub happens. And this is when, this is why we don't like this particular deal. At the end of the ownership, you do an accounting and you determine if Dan has received all of his distributions. And if he hasn't, you are writing a check. So you better be prepared. All right? So that means that when you are sitting at the closing table and you're doing your, figuring out how much, who gets what, the first money after all the expenses are paid for the sale of the property, before you can count a dime in your pocket, Dan has to have received his 45% cumulative return on the deal. If he hasn't, it comes off of the appreciation or what you're collecting, goes right to Dan, and then Dan is done. After that, you then divvy everything up on a pro rata share basis. Okay? You get it? How does that sound? A little scary, because if you don't hit it, Dan doesn't, you're going to have to write a check at the end. Now, hopefully the check is going to come out of the appreciation of the property. But if it doesn't, where does it come from? Well, it depends upon what it's secured by. If you personally guaranteed to Dan that you're going to pay him this return, then you're on the hook. You personally guaranteed that return. Now, if you said it's the company that's responsible for the return, well, okay, if the company has it, it pays it. If it doesn't, sorry, Dan, you didn't make your money. So that's how the look-back provision is. Now, let's take another look at some of these types of deals. Another solution is what we call the catch-up provision. Now, this is similar to the look-back, but it does it in almost the opposite way. It's almost like paying down a debt for you, and here's what I mean. The look back, the catch-up provision differs from the look back provision because the sponsor doesn't take a dime until the equity investor has received all of his promised funds. Now, think about it this way. In the same example we've been using, in the same example we just used in the look back provision, Dan puts in $1 million. Your plan is to hold this property for 5 years, and you're going to pay Dan 9%. So Dan is going to get 9% per year for 5 years, or on a $1 million, he's going to get $450,000 return on his $1 million. So on a catch-up provision, that means that if the property makes $1 million, and property makes $450,000 in the first year, you take that money, you give it to Dan, you're all caught up. Dan, we're good. You just get your money. Maybe we'll do it on a net present value basis. But Dan, I owed you at the start. I owed you $450,000. By the end of 5 years, I'm going to pay it all to you right now. And Dan's done. Everything after that point, I get to keep because I met my obligation to Dan in the catch-up provision. Now, that's what we're talking about as far as doing creative deal structures, all right? The other solution is for multiple solutions, all right? What do I mean by that? Let me give you an example, a couple different examples coming up. In the Dan Johnson scenario where Dan owns 65% and you own 35%, let's say you give Dan a preferred return of 8%, okay? We all know how that works. Then once Dan gets his 8%, all additional distributions go to the sponsor on an 80% split until another milepost has been achieved. So there's two scenarios right there of creative solutions being combined to make the deal interesting. Then everything after that reverts back to the original ownership structure of 65-35. So there are three choices right there that you can do in one scenario, okay, with one particular deal. Now, let's get into some of the technical aspects of all of this because I want you to understand how this operates. I can sit here and tell you all this stuff on a theoretical basis, but we've got to put it in practice, and I want you to understand how these things are put into practice. So the first question is where do you disclose this information? Okay, 3 places. The first one is in the offering memorandum, okay? The offering memorandum has to, it doesn't have to say it, okay? But it's good business practice to disclose the different deal structure for your equity investors. Not disclosing it is very poor form, and that's not how you want to run your business. Does it have the power of a contract, the offering memorandum? No, it doesn't, but it can come back to haunt you. I wouldn't want to be in a witness stand and with opposing counsel pulling out my offering memorandum that says one thing and everything else says something else. So make sure that the offering memorandum ties into how the deal is finally structured. Okay, now the next document is the private placement memorandum. Remember, we're raising private money. We're issuing securities. We need to have a PPM, private placement memorandum. This document, drafted by a securities attorney, don't try to do this on your own, children, drafted by a competent securities attorney, is going to disclose properly how the waterfall distribution arrangement is structured. That is going to be your biggest form of protection, okay? Because that is going to if once again, using the example, you're sitting on the witness stand, the opposing counsel walks up and says, show me where you promised to pay this way, and you pull out the PPM, and right there it says this is how the waterfall distributions are to be handled. Okay, so the private placement memorandum is where you want to have this information. Now, the final document that has to have it is, think about it. The PPM is for getting the business started, is for raising the private money. Once you've raised the money, the company is in business. Well, what is going to determine how the company is run? If it's a limited liability company, that document is called the operating agreement. So all of this stuff as it relates to the ownership of the property and the operations of the property have to appear in the operating agreement. That's why it's important to have a securities attorney who's also going to write the PPM and the operating agreement. The two of them should mirror each other. And that's where this information is going to be disclosed. So that's how you tell your investors, this is my deal. Hope you like it. All right. Now, when do you use these creative solutions? I'll tell you, I think it's easier. Remember, a confused mind says no. If you can keep your deal as simple as possible, you're probably going to have better luck raising the private money. But if your deal is a good deal, but for some reason it's not giving the returns that you need it to, that's when you need to think creatively about how should I structure this deal to get Dan Johnson's money into it. So you have to think about what is the flavor of your investor's money and how can I structure it so that they're all happy with what's going on. Now, remember, especially if you're a new investor, you've never done this before, you can't get greedy. You might have to give up a little bit more than you think you should in order to make the deal happen. All right, so in this particular case, in these examples we're giving, we're doing this deal. It's a great property. Look at those returns over time. We might, have a value play here that you're not going to see these returns until later on, and we believe in this deal. But Dan Johnson's looking for 9%. Oh, geez, Dan, this deal's not spitting off 9 this year. We have to do a lot of work to get it to that point. Well, I need 9. I need 9%. It's okay, fine. I'll give you 9%, and here's how we're going to do it. But if I hit these other guidelines and hit these other mileposts, I want something different myself. And that's how you start to negotiate with your cash investors to come up with a solution that gets them in the deal and gets you a great deal and gets you working. Okay? Let me talk to you about just one very simple real life scenario. So just remember, not all investors are the same. What you want to do is ask your investor, what is it going to take to get you into this transaction? Because what's happening is, so many new investors look at this and say, oh, I've got to, look at my cash on cash return. It's fantastic. We're going to split this deal 50-50. And then you sit down with your investor and find out, no, that's not what they want. They want something different. Well, you've got to have that conversation with them beforehand. That really helps, and it's going to help you when you finally structure the deal to go back to that cash investor and say, hey, remember that time we had lunch over at the Howard Johnson's and you told me that that we were going to, you were willing to invest in my deal if it looked like this? Well, guess what? I got a deal that looks exactly like you said. What do you say? And it makes it a little bit harder for the guy to say no. So in this particular case, this is a true story, and I think I mentioned this some other times before. I had this investor, a student, who had an investor who wanted 9%. He wanted 9%. Did you hear what I just said? He wanted 9%. That's all he wanted. Just here's $100,000. Give me 9% return every year, and at the end of 5 years, give me my $100,000 back. No appreciation, no mortgage paydown, nothing. That was all this investor wanted. That's a very interesting deal structure. That's a creative deal structure. How do we solve that problem? It really isn't much of a problem. We structure the deal so, we can make it look like a debt instrument, like we borrowed the money from him at 9%, or we can do something where we create a category within the operating agreement of a class of membership that just gets a 9% return. At the end of the day, they don't get any distributions other than 9%. So that's a very creative way that we can make this deal happen. Okay? So get creative. Don't think that you're stuck in a box. Don't think that all the other solutions that you've heard are the only way you can do this business. Get creative. Solve your investor's problem. That's what salespeople do. They solve their customers' problems. And remember, You're a salesperson. You have to sell your deal to that cash investor. Then he has to buy your solution. So get creative. And that's how we're going to do it. Now, for those of you, this is, send any questions that you have. You can either type it into the box on the bottom and I'll get back to you, or just drop me an email, info@multifamilyinvestingacademy.com. And if you are in the owner forum, you obviously know how to get a hold of me through WhatsApp, texting, or give me a call on my cell phone. And all masterclass members, you can just drop me an email and I'll get back to you when I can. All right, everyone, I hope this was helpful. I can usually tell by the questions and the conversation that takes place afterwards. But make sure that you get back in touch with me. Thanks, everybody. Talk to you soon.